Welcome to CEC Gurukul live lecture series on financial management. Myself Aditya P. Tripathi, I am once again with you to extend our discussion on this lecture series of financial management. And the topic of today's discussion is capital structure planning and designing part 2. And before I start for part 2, let me tell you what we discussed in part 1. In part 1 I told you about the basics of capital structure decision. Then we talked about the net income approach, and into that net income approach we tried to understand it numerically. And after completing that, today we will be discussing the further 3 approaches, that is net operating income approach, which is NOI approach, the traditional approach, and the last one will be Modigliani-Miller approach, that is MM approach, with and without taxes. So today we will be discussing the remaining 3 approaches of capital structure decision, that is NOI, traditional, and Modigliani-Miller approach, right? So before I start with the NOI approach, let me first show you what we did into NI approach. NI approach is actually of opinion that capital structure decision is relevant to the firm's value, which means any change into capital structure is going to result into the change into the value of firm and obviously the cost of capital as well. So if you look at the answer of the last question which we attempted at a glance, in situation 1, when the firm was having a debt of rupees 5 lakh rupees, the value of equity came to be rupees 7 lakh, debt was 5 lakh rupees, total value of firm became 12 lakh rupees and cost of capital obviously 8.33%. And the moment we increase the quantum of debt into our capital structure, what is the reaction, what is the outcome? The value of firm changed from 12 lakh rupees to 12 lakh 80,000 rupees, whereas the overall cost of capital declined from 8.33% to 7.81%. My dear students, mind this particular change, that when you increase the quantum of debt into your capital structure, your overall cost of capital is reduced to 7.81% from 8.33%, whereas your value of firm, which was 12 lakh rupees, now it has become 12 lakh 80,000 rupees. And moving ahead, when we further change our capital structure and we reduce the quantum of debt from 5 lakh rupees to 3 lakh rupees, what happened? The value of firm also reduced to 11 lakh 20,000 rupees and the overall cost of capital increased to the quantum of 8.92%. So my dear student, in this way, net income approach given by Duren, it actually supports, it says that yes, the answer to the question that whether capital structure decision is relevant to the firm's value or not is yes, that yes, any change into capital structure is going to change your value of firm as well as your aggregate cost of capital or weighted average cost of capital. Moving ahead, now we'll talk about the NOI approach, which is known as net operating income approach, right? The NOI approach is also given by the same person, that is Duren, and Duren says that this approach is entirely opposite to what he said into NI approach. So this NOI approach is entirely opposite to NI approach because it believes that the value of firm is not affected by capital structure changes. According to it, the advantage of debt is affected by the increase in equity capitalization rate. My dear student, try to understand this particular term, that the advantage of debt, whatever advantage you are creating by the increased quantum of debt as per NOI approach, that is going to get eliminated by the increase into rate of equity capitalization, meaning thereby if you are trying to reduce your overall cost of capital, your equity shareholders, they are going to increase their expectation, that is expected dividend, and the result by what will happen, your equity capitalization rate will increase and ultimately plus minus the impact is zero onto your weighted average cost of capital. So this is actually the belief of this particular NOI approach, and to support that approach they have taken certain assumptions. Just like into NI approach we had certain assumptions, here too we have certain assumptions. Like number 1, the first assumption is there are no corporate taxes. So NOI approach also considers this, that there are no corporate taxes, which means we have to ignore taxation while doing our all computations. The second assumption is the debt equity mix does not affect the overall cost of capital. So mind here, my dear students, that this approach is also saying that debt equity mix does not affect the overall cost of capital, which means whatever changes you are making into your capital structure, obviously your specific cost is going to change, and cause of that, as per this approach, if we believe them, there is no change into overall cost of capital. This is what is their assumption, although in reality this doesn't happen. because any change into capital structure is going to change your specific cost, and if your permutation combination is getting changed, obviously it will be reflected into your overall cost of capital, that is going to change. But as far as the assumption of this particular approach is concerned, they are saying that there is no change into their overall cost of capital. The next assumption is the increase in debt changes the risk perception of shareholders. My dear students, into NI approach as compared to NI approach, into NOI, they are saying that yes, the increase in debt is going to change the risk perception of shareholders. But to eliminate that impact, they are saying that whatever change in the whatever benefit you are creating out of inclusion of debt into your capital structure, the same is going to be eliminated by the increased expectation of shareholders. This is what this particular approach is assuming. And the next assumption is cost of debt is constant. So KD is constant, it means the value of debt is supposed to be constant. So according to them, cost of debt is constant. So these are the assumptions taken by NOI approach or net operating income approach. With this assumption, they are giving you certain set of formula just like they gave into NI approach. Into NOI approach, the first formula which they are giving for computation of value of firm is actually the same basic formula which I introduced with you at the very outset when we were discussing the introduction of capital structure. As per it, value of firm is equal to EBIT divided by overall cost of capital or aggregate cost of capital, that is EBIT divided by KO. The second formula which they are giving is for computation of value of equity, that is market value of equity. My dear student, here there is a change as compared to NI approach. Now they are saying that value of equity is equal to value of firm minus value of debt, which means that your value of equity is entirely dependent upon the value of debt. So value of firm, you are computing whatever computed value you have got out of the first formula, you have to deduct the quantum of debt out of it to arrive at value of equity. So this is the second formula which this NOI approach is giving to us. The third formula is for rate of equity capitalization, or for the purpose of computation of cost of equity. For the purpose of computation of cost of equity, they are giving you a formula, that is cost of equity is equal to EBIT minus interest divided by V minus D, that is market value of equity. So alternatively, you can have a formula that EBIT minus interest divided by E as well, right? So these are the three formula given by NOI approach. With this formula, we'll try to calculate the value of firm under NOI approach, right? So this three formula we are supposed to keep in our mind when we are going for computing the value of firm as per NOI approach. Let's have a numerical problem in front of us to understand that what practically this NOI approach wanted to say about capital structure. Suppose there is a question that net operating income of a company is rupees 1 lakh. The overall rate of capitalization, that is overall cost of capital, is 10%. The outstanding debt is rupees 2 lakh with 8% as cost of debt. What will be the value of firm and rate of equity capitalization if number one, the debt increases from rupees 2 lakh to 3 lakh, which means they are changing the capital structure, the debt is increasing from rupees 2 lakh to 3 lakh. And the second is when debt decreases by rupees 1 lakh. And lastly, the question is saying use NOI approach to answer these questions. My dear students, whenever you are attempting the question of capital structure, first of all, we have to search for which method are we supposed to opt, which approach are we supposed to opt for answering this question. And here the question is telling you that we have to make use of NOI approach, right? So the moment you are sure about this, that we have to make use of NOI approach, now we have to get reminded of the formula. Formula is known to us that there are three formula. One is for computation of value of firm, the second is for computation of market value of equity, and last one is for market cost of equity. So with this question, we will just try to solve this particular question as per NOI approach under different situations. Let's have a look at the possible solution. If you look at situation number 1, the first column of the first vertical of this particular table, what we are supposed to do is we have to first apply the first formula, that is value of firm. As it is very much clear from the question that EBIT and KO both are given, the question tells you that EBIT is rupees 1 lakh, cost of equity is 10%. If we divide it, the value comes to be rupees 10 lakh, which is your value of firm. My dear student, you have to mind it here that as per NOI approach, since we are assuming that it is not relevant to the firm's value, so regardless of change into the capital structure, your value of firm is supposed to be the same. So if you do the calculation into situation number 2 or 3, in all situations your value of firm is supposed to remain the same, right? So in situation number 1, the value of firm comes to be 10 lakh rupees, and if you look at other verticals also, other columns also, the same is the value of firm. The same formula we have copied and pasted. Value is equal to EBIT divided by KO, that is 1 lakh by 10.10 is equal to rupees 10 lakh. So in all three situations the value of firm remains the same. In the now we are coming back to the first vertical. The next value is debentures. The value of debenture is given to be rupees 2 lakh, and since the question says that cost of debt is constant, KD is constant, so value of equity is equal to V minus D. This is the second formula we are using here. 10 lakh rupees is the value of firm, we have just calculated. 2 lakh rupees is actually the value of debt, and obviously the market value of equity becomes rupees 8 lakh. So 10 lakh rupees is the value of firm, 2 lakh rupees is the value of debt, so obviously the differential value will be the market value of equity. So in this way we have applied the second formula given by NI approach into the first column into the situation number 1. Now moving ahead, we can calculate as instructed by the question the cost of equity. For cost of equity, the formula is EBIT minus interest divided by market value of equity. So EBIT was 1 lakh rupees, will deduct interest out of it, 8% of 2 lakh rupees, which comes to be 16,000. 1 lakh minus 16,000, 84,000 divided by the market value of equity, that is 8 lakh rupees, and the value comes to be 10.50%. So my dear student, here we have calculated for the existing capital structure the value of firm, market value of equity, and cost of equity. Now moving ahead, in situation number 2, since as I already told you how to calculate the market value of firm, that is given there 10 lakh rupees. Now it's time to calculate the market value of equity, which is 10 lakh minus 3 lakh, because we have increased the quantum of debt from 2 lakh rupees to 3 lakh rupees, and here the market value of equity becomes 7 lakh rupees, right? And cost of equity, to calculate that, EBIT minus interest divided by market value of equity. Now again 1 lakh rupees was my EBIT, 8% of 3 lakh rupees becomes 24,000 rupees, 1 lakh minus 24 becomes 76,000, that is my EBIT minus interest, that is numerator into the formula of cost of equity divided by market value of equity, that is 7 lakh rupees, and now my cost of equity is 10.85%. right? And in situation number 3, the same step we have to follow, where the market value of equity becomes 9 lakh rupees, because we have reduced the quantum of debt from 2 lakh rupees to 1 lakh rupees, and cost of equity has declined from 10.50 to 10.22%. My dear students, we have to observe here that whether we could follow NOI approach properly or not, or in a right manner or not. If we look at the value of firm remains the same in all situations regardless of change into the capital structure. So here we have actually restored the very basic soul of this approach, that it is not relevant to the firm's value, which means regardless of change into our capital structure, value of firm remains the same in all three situations. But as the question said that cost of debt is going to be constant, the moment you will change the quantum of debt into the capital structure, there would be change into the risk perception of equity shareholders. So if you look at this particular situation number 1, your cost of equity was 10.50%, and the moment you increase the quantum of debt from 2 lakh rupees to 3 lakh rupees, these equity shareholders, as per the assumption of this approach, they might have increased their expectation from the company, and they might have increased their expected dividend, result by their cost became 10.85% as compared to the erstwhile 10.50%, which is an increase here. So we have to understand that whatever NOI wanted is being implemented here. Whereas in situation number 3, when we reduce the quantum of debt, there is a reflection of change into your cost of equity, and what is happening, your cost of equity is now reduced to 10.22% from earlier 10.50%. So my dear student, as per NOI approach, whenever we are solving a question, we have to mind this, that the value of firm should remain the same in all situations. Whatever change you are making into capital structure, there is not supposed to be any change into your value of firm. Whereas your cost of equity is bound to change, so we have to observe the direction of our question, of our answer, that according to the question, whenever I am solving a question of NOI approach, I can very easily observe whether I am going into right direction or not. If my value of firm remains the same, then it is okay, and if the cost of equity is changing according to the change into the quantum of debt into capital structure, it means I am going in the right direction. But remember, when you are increasing the quantum of debt, cost of equity has to increase. And when I am going opposite to it, that is reduction of debentures into my capital structure, my cost of equity is supposed to get reduced or decline. So this is what NOI approach wanted to say. My dear student, NOI initially came up with this idea without taxation. There is no tax into NOI approach initially, right? Later on, they also introduced the quantum of the point of tax into their approach. That we'll discuss in due course of our this present lecture today, right? Now moving ahead to the third approach, which is known as traditional approach. NI said that yes, it is relevant. NOI said no, it is not relevant to the firm's value. It has means capital structure. In traditional approach, we are again coming back to yes. So whatever NI said, the same is being supported by traditional approach, which says that yes, it is relevant to the firm's value. Any change into the capital structure is going to bring change into your overall cost of capital and result by your value of firm. Right. So traditional approach is basically, it's a compromise between NI and NOI approach. My dear students, remember, traditional approach is very balanced. It is giving you a very balanced outlook about the impact of capital structural changes onto the value of firm and overall cost of capital. That is why we are saying that it is a compromise between NI and NOI approach. Although in principle it is supporting whatever NI said, whatever net income approach said, but with certain moderations. That moderation we are supposed to discuss here. I'll be telling you in due course of my discussion again. It states that the cost of capital, this traditional approach is saying that the cost of capital decreases within reasonable limit of debt and then increases with the leverage. My dear students, we have to point it out here that traditional approach is saying that the cost of capital, that is KO, decreases within reasonable limit. I mean, there is a limit of change into the cost of capital with the increase in the quantum of debt and then increases with the leverage. So this NI approach and this traditional approach is willing to tell you that unlike NI approach, they are not saying that every increase into debt is going to have a positive impact onto your value of firm and cost of capital. It may be negative also. So it might be possible that initially when you are increasing the quantum of debt into your capital structure, might be possible your cost is declining, but after a certain limit it is going to increase with the leverage. This is what they wanted to say, and that is why we are saying that traditional approach is giving you a balanced idea. Now this approach believes that through a proper use of debt equity proportion, a firm can increase its total value and eventually they can reduce their overall cost of capital. So they are saying that you can make a proper combination of debt and equity proportion where your objective is to increase the total value, and obviously if your value is increasing, it is supposed to reduce your overall cost of capital. So this approach is of this particular belief that if you are making a proper use of debt equity combination, a proper combination of debt equity can have a positive impact onto your value of firm and obviously result by it is going to reduce your overall cost of capital. It believes that there is no optimum capital structure, but it can be at optimum level in a range. My dear students, remember here the very basic point of this particular approach is that it is saying that we cannot give you a ready-made formula for this capital structure that C 2:1 is going to be your ideal combination of debt and equity. It is saying that we cannot give you any optimum capital structure, but remember we can ensure that it can be at an optimum level in a range. So we can provide you a range that if you are increasing the quantum of debt to up to a certain limit, obviously it is going to be into your favor, that is increase in the value of firm and reduction in the overall cost of capital. So this is what this approach is saying, and my dear students, because of this particular line of this approach is still having greater relevance because it is giving you the realistic opinion, realistic idea that you cannot have any optimum capital structure, but you can ensure the range which is optimum, which is into your favor. So you can have a capital structure which is at optimum level but in a range. This is what this capital structure approach as per traditional approach is telling you. Remember, my dear student, there is no further formula, no additional formula for computation of value as per traditional approach. As per traditional approach, we are making use of the same formula which we used into NI approach. So formula used in net income approach is going to be used for traditional approach as well. So in this way, we understood theoretically what is there into the traditional approach. Now let us understand this particular traditional approach by a numerical question, right? Suppose if a company is having an EBIT of rupees 3 lakh, it has an outstanding debt of rupees 12 lakh and the cost of debt is 10%. Cost of equity which is estimated there is to be 15%. So the question is giving you EBIT, amount of debentures and their cost and cost of equity. And what is required from us is we have to determine the current value of firm using traditional approach, and eventually we have to calculate overall cost of capital, that is KO or WACC, weighted average cost of capital. Now here the question is not giving you any idea that which method to be opted, or it can have this particular line that use traditional approach to answer this question. But if the question is not giving you any line, you can make use of traditional approach. But here in this question nothing is mentioned, so we can have a calculation here. EBIT given in the question is rupees 3 lakh. Interest on debentures at the rate of rupees 10%. Amount of debt was 12 lakh rupees. 10% of that comes to be rupees 1,20,000. When we deduct it from 3 lakh rupees, the net income available to equity holders or nahi aate becomes rupees 1,80,000. Cost of equity given in the question is 15%. Now we have to make use of formula given as per NI approach. In NI approach, we were computing the market value of equity by this formula, that net income available to equity holders divided by cost of equity. Net income available to equity holders here is 1,80,000. Cost of equity is 15%. When we solve it, the value of equity comes to be rupees 12 lakh. Now further we can calculate the market value of debt by this formula, interest upon KD. Even if we don't calculate, the value remains the same, that is 12 lakh rupees, but we can calculate here with the help of this formula. If we wish to, 10% is the rate of interest, 1,20,000 divided by 10% becomes rupees 12 lakh rupees. Now since we have calculated the market value of equity and debt, we can very easily find out the value of firm by combining these two components, that is equity and debt, and value of firm becomes rupees 24 lakhs. So here in this way, for traditional approach, we have actually used the same formula which is given into NI approach, right? Now we can calculate the overall cost of capital by this formula, EBIT by value of firm. EBIT is rupees 3 lakh rupees, value of firm is 24 lakh rupees. We have just calculated, multiplied by 100 because we want the answer in terms of percentage, and the cost of capital, the overall cost of capital becomes 12.50%. So in this way, we have attempted to understand how to calculate value of firm as well as aggregate cost of capital or overall cost of capital by using traditional approach into our capital structure decision, right? Suppose moving ahead, we are going to make some change into this given question, and we are trying to understand the effect of redemption of debt into the same question. And in the same problem, suppose the firm is considering to issue equity shares of rupees 4 lakh in order to redeem debentures of rupees 4 lakh, which means that this particular issue is with the purpose to redeem the debentures, right? And KD is expected to be the same. With this move, there is no change into the KD. However, the KE's estimated cost of equity is estimated to become 13%. Due to decline in the leverage, which means that if you are reducing the quantum of debt, shareholders are taking it positively, and in response to that, your cost of equity is decreasing from earlier 15% to now 13%. Now the question is asking you, will you recommend this proposal? And to recommend this proposal, they are asking you that you have to use traditional approach to answer this particular question. I hope you have understood the question. In this question, we are giving you an additional problem that we have issued some equity shares of rupees 4 lakh to redeem some debentures which are of the same value, and because of this particular move of the company, there is no change into cost of debt, but cost of equity is changing, and the examiner is asking you that are you going to recommend this proposal? So you have to answer this question by using traditional approach. Let's try to answer, right? The same EBIT is there, rupees 3 lakh. Interest on debentures at the rate of 10% will now not be 1,20,000 because 4 lakh rupees we are going to redeem. So we will be having the remaining amount of debentures of rupees 8 lakh. 10% of 8 lakh becomes 80,000. Divide 80,000 from 3 lakh rupees. Your net income available to equity holder becomes rupees 2,20,000. Now we can calculate with the given cost of equity of 13% the market value of equity, which is 2,20,000 divided by 13%, that is 0.13, because the formula is net income available to equity holders divided by cost of equity. Now, my dear students, here the market value of equity becomes rupees 16,92,308. And market value of debt, obviously it remains the same, 8 lakh rupees. But if you wish to calculate, you can calculate by using this formula, interest upon KD, which becomes 8 lakh rupees. When we combine these two values, that is market value of equity and debt, we come to know about the market value of firm, which now becomes rupees 24,92,308 rupees, right? So and if we have to calculate overall cost of capital, very simple, EBIT by value of firm, 3 lakh rupees divided by 24,92,308 into 100, the value becomes, the cost of capital becomes 12.30%. Now, with this given value of firm and cost of capital, we have to take a decision that whether it should be accepted or not. What is my decision? We have to compare both the values of firm. Since the value of firm has increased from 24 lakh rupees earlier to 24,92,308, so it's a positive move. Because of this change, value of firm has increased. Secondly, overall cost of capital has declined from 12.50% to 12.03%. Hence, we can say that since both the components, that is value of firm and overall cost of capital, they are into our favor, so I can say that the proposal should be accepted. So in this way, my dear students, we have tried to attempt a practical problem question as per the traditional approach of capital structure, and I hope you must have understood how to calculate the value of firm as per traditional approach. My dear students, into traditional approach, we have to very simply make use of the formula which is prescribed into the net income approach, because both the approaches, they are having the similarity on this ground that they are saying yes, this capital structure decision is relevant to the firm's value. So there is no change in principle in relation to these two approaches. But my dear student, this traditional approach is more balanced because it is giving you an idea that you cannot find any optimum capital structure, but you can find them at an optimum level in a given range. Now, moving ahead to the most important and widely discussed approach, that is known as Modigliani and Miller approach, MM approach. It is regarded as MM approach. This is actually in our discussion of these different approaches after NI, NOI and traditional. This is the fourth approach into our discussion, of this particular chapter of capital structure. Before I tell you about the Modigliani and Miller approach, let me tell you that what is there in the background. Remember, if you recall the first very lecture, the capital structure decision part 1, there I told you about the four approaches, the flow chart of that, and in that I showed you that there is a symmetry of yes, no, yes, no. One approach is saying yes, other is saying no, third one is saying yes, and fourth one is saying no. So in that series, NI was saying yes, it is relevant to the firm's value. NOI was saying no, it is not relevant. Traditional was saying yes, it is relevant. Now again, the Modigliani and Miller approach is of opinion that no, capital structure decision is not relevant to the firm's value. And my dear student, into this MM approach, Modigliani and Miller approach, which is identical to that of NOI approach. So whatever NOI approach said, the same is going to be endorsed by this Modigliani and Miller approach. But remember, as compared to NOI approach, they are giving you some behavioral justification to whatever they are saying. As per Modigliani and Miller approach, if we talk of Modigliani and Miller approach, this particular approach says that there are two situations. One is without tax and the other is after tax. So first of all, we'll start with the MM approach with taxes. So now we are talking about Modigliani and Miller approach, MM approach. Initially the MM approach also ignored the concept of tax. It said that there are no taxes. So in due course of my discussion, I'll tell you that what MM approach initially said. This approach actually supports the NOI approach relating to cost of capital and degree of leverage. Leverage, you understand, we have already discussed the degree of financial leverage. It maintains that the WACC is not affected by the proportion of debt to equity on the capital structure. So my dear student, this approach is actually saying that we are supporting NOI approach, which is related to cost of capital and degree of leverage, but it maintains that the weighted average cost of capital is not affected with the proportion of debt to equity on the capital structure, which means that if you are making change into your capital structure by either increasing the quantum of debt or decreasing the quantum of debt, your capital structure, your weighted average cost of capital is not going to get affected as far as Modi, Gliani and Miller approach is concerned. It actually offers a behavioral justification for this particular statement, and this particular behavioral justification is given by a process called arbitrage process. So I'll be telling you what is arbitrage process and how it works in due course of my discussion. But remember, this is the point where this Modi, Gliani and Miller approach is different from that of NOI approach. NOI approach, gave you a formula to calculate the value of firm. It said that KD is constant, whereas Modi, Gliani and Miller gave us a behavioral justification in the name of arbitrage process. Now I'll tell you that what are the different proposals given under approach. Modi, Gliani and Miller actually gave 3 proposals which under this particular approach. Now what is the first proposal? Let's try to understand. The first proposal of Modi, Gliani and Miller approach says that overall cost of capital, that is KO, and value of enterprise, that is value of firm, they are independent of its capital structure, which means that the KO and value of firm, they have no relationship with the capital structure, and they are saying that KO and V, that is cost of capital and value of firm, are constant for different degrees of leverage, which means that if you are changing the degree of leverage, there is no impact of it either on KO or onto V, that is overall cost of capital and value of firm. And my dear student, remember, into this approach of capital structure said that whatever they are saying is actually applicable for 2 identical firms which are similar into all aspects except one, that one is levered and the other is unlevered. The second proposal, so the first proposal talked about KO and V are independent of its capital structure, and the second proposal which came under approach is that cost of equity increases in a manner to offset the use of sources of funds represented by the less expensive means of debt, which means that they were saying that whatever benefit you are creating, suppose for example your cost of capital is 12%, overall cost of capital is 12%, and with the increased quantum with the inclusion of debt, you have tried to reduce your overall cost of capital by 2%. What is saying, whatever benefit you have created by the inclusion of debt into your capital structure, the same is going to be eliminated by the increased expectation of equity shareholders. So my dear student, mind here, what they are saying is that suppose if you have created a benefit of 2% by reducing your overall cost of capital, the equity shareholders are going to demand for exactly the same proportion, that is the 2% increased expectation, which means that they will increase their cost of equity by 2% because you have created a benefit of 2%, and ultimately the net impact is 0. But my dear students, in practical life this doesn't happen. Might be possible that as a shareholder I may increase my expectation in a greater proportion as compared to what benefit you have created, or it can be vice versa. It can be on the lower side also. You have created a benefit of 2% and shareholder may increase the expectation by 1% also. So we cannot be very sure, but as far as approach is concerned, it says that cost of equity increases in a manner to offset the use of sources of funds represented by the less expensive means of debt, which means that whatever benefit you are creating, the same is going to be eliminated by this particular increased expectation of equity shareholders. The last or the third proposal given under approach is that cutoff rate is independent of the way in which investment is financed. So it is saying that our cutoff rate or WACC, weighted average cost of capital, or expected rate of return is independent of the way you are going for taking your financing decision, that whether you are using equity, debt, retained earning or preference shares, it is independent. So according to them, WACC is used as a cutoff rate, and cutoff rate is independent of the way you go for financing your investment proposal. So with these 3 proposals under consideration of approach, we'll go ahead to discuss the assumptions of approach. approach, just like NI and NOI, is having certain assumptions. The first assumption is there are perfect capital markets. My dear students, the first very assumption is that there are perfect capital markets. If we try to elaborate it, it means that the investors are free to buy and sell securities. Investors have complete information about the market, and moreover, according to them, the shares are homogeneous in nature. If we go by considering this point of assumption of there are perfect capital markets, just like perfect competition in the market structure, when you studied into economics, there we have told you that what are the symptoms of perfect competition, that homogeneous goods are there, investors have complete information about the market, investors are there are large number of buyers and sellers in the market, and the customers have complete information about the market. Whereas in real life, as far as capital market is concerned, nobody can claim that I have complete information about the market. But as far as their assumption is concerned, I'm not demotivating you, I'm just telling you that this is the first assumption, that there are perfect capital markets, which means investors are free to buy and sell securities. The second assumption into this series of assumption is individuals can borrow at the same terms and conditions as firm can, which means that they are telling you that whatever terms and conditions are applicable for individuals to borrow, the same is applicable for the firm as well. So there is no change whether you are going for borrowing as an individual in the market or you are going for borrowing as a firm, which means there is no benefit of, you can say, the bulk purchase, or there is no benefit of buying into bulk or going for negotiating when you are taking loan into large quantity. So as far as their assumption is concerned, individuals can borrow this at the same terms and conditions as the firm can. And the next assumption is all investors have same expectations and awareness to the value of firm, which means that whosoever is coming into the capital market is having the same expectation from the market and the company, and they have the similar level of awareness with regard to the value of the firm. Moving ahead, their next assumption is dividend payout ratio is 100%, which means that the firm is not going to retain any amount out of their total earnings. The DPR, or the dividend payout ratio, as far as assumption of approach is concerned, is supposed to be 100%. Right. So with this assumption, and moving ahead, they had another assumption that there are no taxes, just like NI and NOI. They are also of this opinion that there are no taxes, although in practical life we have taxes. Business risk is equal among all firms with similar operating environment. They are saying that there is no change into the business risk for different firms operating into our economy, because if they are operating in a similar operating environment, business risk is equal as far as approach is concerned. And the very important part of their assumption is that there are no transaction cost, which means if you are switching from one firm to another, there is no transaction cost involved into it. According to them, every investor has the freedom to switch from one firm to another without any restrictions or cost of making the change. My dear students, 2 points are very important here. They are saying that there is no restrictions for making change, and the second is there is no cost of making this particular change. So with this assumption that the investor has the freedom to switch from one firm to another without any restrictions or cost of making the change, will try to exhibit in front of you the way arbitrage process, the way their behavioral justification works, right? This approach is actually justifying its opinion by the way of two things. One is arbitrage and the second is reverse arbitrage process. Before we tell you practically what is arbitrage, the way arbitration is done, the way we go for understanding whether arbitrage is possible and profitable or not, we have to understand what is arbitrage and what is reverse arbitrage. My dear students, by while ending their assumptions, approach said that the process of shifting from one firm to another, which according to them is arbitrage, if an investor is switching from levered firm to unlevered firm, that is called arbitrage, and according to them this process of switching from one firm to another will continue till value of both the firm becomes equal. This is what we'll discuss at the end of our numerical discussion. Before that, we have to understand what is arbitrage process. Before that, we have to first understand what is the literal meaning of, what is the meaning of this particular term, arbitrage process. Arbitrage refers to an act of buying a security in one market having a lower price and then selling it in the other market at having higher price, which means that I am having two markets in front of me, and I am buying from the market where the price is low, and I am trying to sell it in the market where the price is high. So which means that I am making use of the change in the price of a particular product. It can be share also. So whatever benefit I am getting, it is only because of this fact that there are two different markets which are having different prices. So I am buying from the market where the price is low, and I am selling in the market where the price is high. So the same principle of arbitrage has been used into approach to explain that the value of levered and unlevered firm will be equal irrespective of their capital structure. This is what they wanted to say, that initially even they have actually accepted that the value of levered and unlevered firm is different, but in due course of arbitrage process, cause of this arbitrage process, the price of both the firm will become equal in due course of time. So in a way they have accepted that yes, it is relevant, although they are saying that it is initially relevant, but after the this arbitration process begins, the value of firm becomes equal, right? So this is what they wanted to say. Before that, we need to understand what is arbitrage process. Suppose if we have an investor who has invested into a firm called levered firm. What is levered firm? The firm which is having debt into its capital structure. So levered means the firm which is having leverage into its capital structure, which means the fixed interest bearing source of finance, or you can say debt is there. So presence of debt makes a firm levered, and absence of debt makes a firm unlevered, right? So an investor switching from levered firm to unlevered firm, this process of switching from levered to unlevered, L to U, levered to unlevered, is known as arbitrage process. So we have understood what is arbitrage process. As far as approach is concerned, they wanted to tell you that if you have an investor who is switching from who is selling the shares of levered firm and willing to invest into unlevered firm, this process of switching from levered to unlevered is known as arbitrage process. And reverse to it will be, obviously opposite to it will be reverse arbitrage. What is reverse arbitrage? An investor who has invested into unlevered firm is willing to switch from unlevered firm to levered firm. This process of switching from unlevered to levered firm is known as reverse arbitrage. So it is very simple to understand. Reverse of arbitrage is reverse arbitrage. So there are two types of firm: levered firm, unlevered firm. When you are switching from levered to unlevered, this is called arbitrage, and when you are going from unlevered to levered, that is called reverse arbitrage. So with this information in the background, now we can start in understanding the arbitrage process. The profit from arbitrage may either be in the form of increased income from the same level of investment, which means that you are getting the increased revenue with the same level of investment. This can be one option which is regarded as a profit from arbitrage, or it can be the same income from less investment. So either I am getting increased income from my same investment, or I am going to have same income from my lower investment by reducing my outlay or investment. So this is what is the profit from arbitrage. Now we can understand this process of arbitration or arbitrage process with a very small numerical example. Two companies, U and L, they belong to same risk class. These two firms are identical in all respect except that the company U is unlevered, whereas company L has 10% debentures of rupees 5 lakh. So we are comparing two firms which are identical into all aspects except one, that one is levered, the other is unlevered, and the one which is levered is having 10% debentures of rupees 5 lakh. The other relevant data which is given here into the table, which we can see that company L and company U, EBIT is given for both the firms. It is 1 lakh rupees because they are identical in all aspects except one, that one is levered, the other is unlevered. Interest is applicable for company L only because it is having debentures into its capital structure. Interest comes to be 50,000, whereas the interest is nil in case of unlevered firm because there is no debt into their capital structure. The earnings available to equity holders is 50,000 in case of company L, and for company U it is 1 lakh rupees. My dear student, we have to understand that approach, initially for arbitrage process they were of opinion that there are no taxes. That is why we have ignored tax here. Equity rate of capitalization or a rate of equity capitalization is given here in this question, 0.16, that is 16%, and for company U it is 12.5%. If we calculate market value of equity, although it is calculated there 3,12,500 for company L, for company U it becomes 8 lakh rupees. Market value of debt for company L 5 lakh rupees, for company U nil. when we aggregated these two values, equity and debt, the market value of firm becomes 8,12,500 and rupees 8 lakh. Overall cost of capital in case of levered firm is 12.3% and in case of unlevered firm 12.5%. Debt equity ratio in case of L is 1.6, and obviously in case of company U it is not applicable because there is only equity into the capital structure. So my dear student, we have not solved anything. This is part of the question. So the question itself is giving you this particular information about the value of firm, the market value of equity, debt, rate of equity capitalization and overall cost of capital. If you look at this question, the question itself is giving you an idea that the value of levered firm is greater than that of unlevered firm, which is 8,12,500, and the cost of capital, overall cost of capital is less in case of levered firm as compared to unlevered firm, cause as far as approach is concerned, it is saying that you are making use of less expensive means of that particular source of capital, that is called debt. Now we have an assumption. This can be given into the question, or we may have to assume if we have to show the effect of arbitrage process. An investor, Mr. A, who is holding 10% equity shares of company L, show the arbitrage process and amount by which he could reduce his outlay through the use of leverage. So here the question is giving you the assumption. You can, if the question is not having this particular para and they are asking you to show the effect of arbitrage process, arbitrage means you have to show the shifting from levered firm to unlevered firm. So here it is saying an investor is Mr. A is holding 10% equity shares into the company L, that is levered firm, and we have to show the effect of arbitrage process, and they are further asking you that according to Modigliani and Miller, when will this arbitrage process come to an end. So we have to answer to these two questions. We have to first show the effect of arbitrage process, whether it is possible and profitable or not, and secondly we have to tell when this process of switching from one firm to another, that is levered to unlevered, shall come to an end, right? So there are two conditions for arbitrage process, that voting power should not change, which means that if you have invested 10% equity shares into company L, you cannot hold more than 10% equity shares into company U. So while showing the arbitrage process, we have to keep in mind that the voting power should not change. So whatever voting power you are having into the existing company, the same has to be acquired. You can not change, which means it cannot go either side, neither increase nor decrease. Change means not change means no change, neither increase nor decrease. So you have to maintain the status quo, that is the similar voting power, which is 10% in this particular question. The second is the revenue income should not decrease. So while declaring that whether arbitration is profitable or not, we have to ensure that revenue income should not decrease. So with this particular condition, we are going to show you the effect of arbitrage process. My dear students, most of the authors into their book, they write that we have to first check the possibility and then we have to further check profitability. According to me, it is always possible, because if it is not possible, if you don't have fund, then do you make it possible by going for taking loan, right, by the borrowing. So in any case, arbitration is possible. So we have to understand that it is always possible. We have to only check whether it is profitable or not. In this particular solution of this question, I'll show you that it is always possible. If it is not possible, we make it possible by simply taking loan. If we look at the present position of investor in company L, we have to first compare the understand or identify what is my present position into company L as investor A. Suppose I am Mr. A who has invested into company L. My capital position is 10% of market value of equity. That is, market value of equity is given into the question, 3,12,500. Now my right into the capital position will be 10% of this amount, that is rupees 31,250. Right? Now we have to understand what is the prospective position in company U. Suppose if I am leaving company L and planning to shift to company U, what is the capital required? If we look at the market value of equity of company U, their market value was 8 lakh rupees, the rate was 10%. If we calculate the required fund to acquire 10% equity shares in company U is rupees 80,000. My dear students, why we are focusing on to the same investment? The reason is the condition for this particular approach was that my voting power should not change. So 10% I have to acquire in any case, which becomes 80,000 rupees. For this 80,000 rupees, if I assume that Mr. A is not having any further amount and he is going to sell out his equity into company L, the sale proceed of this particular shares of company L will be 31,250 rupees. If we deduct the deficit comes of 48,750, we can take loan of this 48,750 from the bank. Now the question comes, what should be the rate? My dear students, it is very simple. We can take the rate of debt given into the question itself, which is 10% for debentures. So the same rate will assume that the loan can be taken at 10%, which means that by this particular act, by this particular decision of borrowing from the bank, we have ensured that arbitration is possible. So this is why I told you that if you have deficit of fund, obviously you can take loan. If it is a surplus, then also you cannot invest more than what you have, more than the voting power, that is 10% if you had in the earlier company, you cannot increase your stake into the other company. So in that case, suppose if you have a surplus, you can invest it somewhere. Now the question comes, what should be the return on to that investment? Obviously the same rate which is applicable here for debt, the same would be applicable for that particular investment. So either the amount is equal. If it is equal, there is no problem. If there is a deficit, take loan. If there is a surplus, invest surplus amount somewhere and create some return, create some interest, earn some interest onto that. So to my mind, my dear students, arbitration is always possible. Now let's see whether it is profitable or not. For the profitability, we have to compare the present revenue position in L Limited with that of prospective revenue position into U Limited. If we look at the present revenue position of Mr. A, he is having a right of 10% into net income available to equity holders, which is 50,000 rupees. So his share out of that nahi becomes 5,000 rupees. And here the condition is this revenue should not decrease, which means 5,000, it may increase. It is good, it is always welcome, but it should not decrease. Let's have a look at the revenue position in U Limited. 10% of nahi net income available to equity holders, it is here 1 lakh rupees, which becomes 10,000 rupees. So we are very happy initially that earlier it was 5,000 rupees, now it has become 10,000. But remember, don't forget to pay interest on the loan which you have taken for making this arbitrage process possible. You took a loan of 48,750. So interest at the rate of 10% per annum, you have to shell out, you have to pay 4,875 out of it, and ultimately the effective revenue is rupees 5,125. So my dear student, the second condition was that your revenue income should not decrease. So in that way, we have actually ensured that my revenue is not decreasing. It was earlier 5,000 rupees, now it has become 5,125. So we can say arbitration in this case is possible as well as profitable, which means that earlier you were making income of 5,000 rupees and now you are making income of 5,125. So in this way, we have tried to exhibit you the way according to approach arbitrage process works. That an investor is switching from levered firm to unlevered firm. You can do the same exercise by making an assumption that we have an investor called Mr. B who is holding 10% shares in U Limited, and you can also identify whether the reverse arbitrage is possible and profitable or not. My dear students, remember, when the question is saying that you have to show the effect of reverse arbitrage, you have to show the shifting of investor from unlevered firm to levered firm. But when we are saying that you have to show the effect of arbitrage process, be very clear that you have to show the shifting from levered firm to unlevered firm. At times students get confused that I don't understand arbitrage process, it is quite difficult. But my dear student, it is this easy. You must have understood how to show the effect of arbitrage process. So here in this question we have showed that arbitration is possible as well as profitable. My dear student, remember, it is not guaranteed that arbitration is possible and profitable, so reverse arbitration will also be possible and profitable. It can be reversed to that. So according to that, we will actually give our decision. So this was the first part of the answer. The second part of the question was, when will this process come to an end? According to this process of switching from levered firm to unlevered firm will continue till the value of both the firm becomes equal. So this is the way Modi, Gliani and Miller approach, along with his three hypotheses, three propositions and different three proposals and different assumptions. They have try to give a behavioral justification that how it is not relevant to the firm's value, how the change into the capital structure is not relevant to the firm's value. Now, my dear student, in this discussion of arbitrage process, there is a short note that the term which comes to us is what is personal or homemade leverage. So at times my students are asking me, sir, what is homemade leverage, or what is personal leverage? My dear student, it is actually defined as a use of leverage by investors in their own portfolio to adjust the leverage choice given by the firm, which is known as corporate leverage. So in place of the given leverage by the firm, by the company, that is called corporate leverage, we are trying to make use of our own leverage into our portfolio management. That is called personal or homemade leverage. So here, when the investor was switching from one firm to another, trying to make use of leverage from shifting from levered firm to unlevered firm, or vice versa, the investor was actually making use of personal or homemade leverage. So this is a term which comes to us. That is why I thought that you should also know that what this personal or homemade leverage is. Now moving ahead to the sequel of this Modigliani and Miller 2, the second part, where the Modigliani and Miller introduced the corporate taxes into the approach. My dear students, here the approach is coming up with the tax, and when we are saying approach with taxes, it is actually applicable for NOI with taxes also. When you are solving questions into the examination, remember, even if the question is telling you that you have to apply NOI with taxes never came with any formula. So we are making use of with taxes only, whether they are asking you to calculate the approach, value of firm as per approach, or the NOI approach. So approach at a later stage introduced with the effects of tax in two identical firms, and they were saying that these two firms are similar in all aspects except that one firm is levered and the other is unlevered, to find out the advantage of debt, right? So according to them, the value of firm will increase and cost of capital will decrease with the leverage whenever you are introducing the taxes, and since the interest is tax deductible, levered firm will have greater value. So when we'll be solving the question into MM2, that is with taxes, the value of levered firm will be supposed to be greater than that of unlevered firm. Remaining part of this Modigliani and Miller approach, that is MM2 with taxes, I'll discuss in my next lecture, which I'll be coming up with soon. So my dear students, I hope you must have understood in today's discussion how to calculate the value of firm as per NOI approach, traditional approach, and into the first approach, that is without taxes. So in the next lecture we'll actually talk about with taxes. Thank you so much.